We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at Plancorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to the Long-Term Investor. This is the first time that I'm recording this on video, so if you've been listening on podcast, you can now see this on video. If you're watching on video, thanks for doing so. I'm really pleased that my first guest is Brian King, the Chief Planning Officer at Plancorp. Brian, in that role, he's directing our financial planning strategy and the policy at Plancorp, and he's also the head of Plancorp's family office. And just for a little background, Brian spent 5 years at PricewaterhouseCoopers prior to coming to Plancorp, and there he was doing work with advanced income and estate planning services to high net worth families and corporate executives. He's a CPA and a CFP, and when I was thinking about people who I could talk to about the latest tax proposals, there's literally nobody better that I could think of. Brian is constantly doing education internally for us. His office is next to mine. I'm in my home office today, but I can always just go next door and ask him a quick question. And so, Brian, thank you so much for joining me today, especially being the first guest here on the show.
Yeah, Peter, thank you. Appreciate you having me, and I'm excited about it. Looking forward to the conversation.
Well, we're recording this live on September 24th. And the reason I mention that is because by the time some of you are viewing or listening to this, the things that we're discussing today can and probably eventually will change. On September 13th, the Democrats in the House Ways and Means Committee released their tax proposals, and the legislation's hitting on a very wide range of issues. And now we're going to watch them debate it in Congress before it's finalized, at least theoretically finalized. But Brian, as you and your team have reviewed the proposal and you see the range of planning opportunities to consider both in the future and perhaps this year, before we're diving into that, I'm hoping you could just give us a high-level overview of where we are in the legislative process and what we might expect to see in coming weeks.
Sure, yeah. And, look, obviously all this stuff has been discussed and talked about ever since the election, ever since our last presidential election. And, late in the spring, President Biden started to put forth details on his own plan for infrastructure spending and kind of more what they're referring to as family infrastructure spending. That process started in late May, and details were released in May, June, July, throughout the summer. And in August is when we started to get to the point where the House and Senate really started to discuss actually drafting proposed legislation, because until that point, really all we had were outlines. And so you already referenced about 2 weeks ago on September the 13th is when the House Ways and Means Committee released the tax proposals that'll be used to fund the various spending initiatives and policies. Now, where we are in the process, if folks are interested in this stuff and following their headlines, there's, I think, obviously lots of rumors and interesting headlines of folks in DC saying things back and forth. But I think where we are in the process right now is that the overall package, right? So in the House, right, there's 12 to 13 different committees that actually are coming together to actually draft this legislation. So they've now all submitted their part of the bill to the House Budget Committee. And this includes the tax proposals from the Ways and Means Committee. So the Budget Committee has now signaled that either today or tomorrow on Saturday, they're actually going to release the full bill out of the Budget Committee, and then it would go to the House Rules Committee. Now, Congresswoman Pelosi earlier today, actually just about an hour ago, she committed to saying that we are voting on this bill next week, and we are voting on the infrastructure bill next week, which has been a big part of the hot button issue because you have kind of two different, I'll call them factions in the Democratic Party. You have what many folks refer to as the progressives and others as the moderates. The moderates are saying, hey, we're not voting for this bigger $3.5 trillion budget reconciliation bill unless the infrastructure bill is voted on and passed at the same time. And of course, then you have the progressives saying, well, if we vote on the infrastructure bill first, we're going to tank that bill and it's not going to pass. So, the Speaker of the House is committing to voting on both bills next week. Will that happen? That's an unknown. And then that's just the House side of things, right? Because all along the way, Congresswoman Pelosi has also said, hey, look, we're not going to pass anything out of the House that we know is not going to pass the Senate. Well, the reality is the Senate is the bigger stumbling block, right? That's where you have a couple prominent moderate Democrat senators who are saying, hey, look, the overall size of this bill is just too big. We're not comfortable with it. And so I think it's, on the one hand, interesting for the House to say, yeah, we're going to vote on these things next week, when the Senate hasn't released any sort of proposal whatsoever. So maybe that means we're going to see something from the Senate over the weekend, but I guess we'll just have to see what happens next week. So Monday is actually my birthday. Maybe they'll vote on my birthday. Give me some
What a
clarity.
way to celebrate a birthday. Working through legislation. And we're going to talk about some of the headlines in this proposal that we're discussing, but there are also a number of just year-end tax planning opportunities that, if you're listening to the show, we're going to get to those after we talk through some of the proposals and some of the different planning implications of those proposals. And even though we know that these might change, the reason it's important to talk about these now is that if this gets passed and there's planning decisions that need to be made in a very short window of time before 2021 ends, you really just don't want to be caught flat-footed. And we have these conversations with our clients. We have these conversations internally so that at least we can start thinking through the different options. And so as we're talking through those proposals, keep that in mind as you're listening. And Brian, I'm going to start just with some of the headline tax proposals. Maybe you could start with the changes in tax rates so we can just go from there.
Yeah, sure. So included in the House proposal it's an increase to the top marginal rate, basically back to where we were in 2017 before the tax bill that was passed during the Trump administration. So right now, our top marginal rate is 37%, and that kicks in at about $600,000 of income for a couple filing jointly. Now, the top tax rate would be 39.6%, and for married joint filers, that would actually kick in at $450,000 of taxable income. So it's a higher rate that kicks in at a lower level of income. And that top rate would also kick in at $400,000 of taxable income for a single filer. And so that is one of the interesting things when you see those disparities that, hey, a single filer doesn't hit that top rate until $400,000, but joint filers hit it at only $450,000. That's one of the many examples in the tax code of what they call the marriage penalty, meaning that the amount isn't double for a joint filer. And so that's just one call out. I'm sure I'll make some others, but there's actually some pretty significant marriage penalties in this proposal, which, I do think is interesting because at the start they were calling it the American Families Plan, but there's a lot of disincentive here, or increases that disproportionately impact joint filers versus single filers. The other piece of that, when we're just talking about kind of the ordinary income tax rates, is that the House proposal introduced a surtax for very high income taxpayers. And so the way that would work is it's not based on your taxable income. It's based on a slightly modified version of what is most commonly referred to as your adjusted gross income. So your income before any deductions, whether that's the standard deduction or the itemized deductions. And so the way the surtax would work is once your income is above $5 million, your gross income is above $5 million, you would pay a 3% surtax on income above that amount. And so it's an important distinction because with the gross income, for example, you couldn't make a large charitable contribution in most cases and offset that surtax because it's based on your gross income, not your taxable income. So, that's the marginal rate. The other big rate increase for individuals that's getting a lot of attention then is change to the long-term capital gains tax rates. So right now we have actually 3 different long-term capital gains tax rates. It's either 0% for folks that are in the 12% marginal bracket or below. Then it goes up to 15% until your taxable income would put you at the point where you're in today's top bracket. So again, we talked about that roughly $600,000 level. And then above that point, it goes to 20%. Well, what this proposal would do is that top rate would be changed from 20% to 25%. And again, it would start applying once you're in the new top bracket. So again, for joint filers, that's going to be once you have taxable income of $450,000 or more. So if you have any capital gain income, if, for example, you have $600,000 of total taxable income, so you have $150,000 of income in that top bracket, let's say $50,000 of that is long-term capital gain income, it's going to get taxed at 25%, not 20%. And that's before you consider the net investment income tax, which was introduced in the Affordable Care Act. So technically, the top rate on a long-term capital gain could be 25% plus 3.8%, so 28.8%.
Well, and one thing that struck me, particularly as I've heard you speak about this in prior instances, is there's a lot of different type of tax names to keep track of at this point. And they're applying in different ways to different business owners. So when you mention that net investment income tax, I don't know that we need to go super deep on it, but I remember you referring to how some of the non-passive income from people might be impacted by this surcharge in a way that they weren't prior. Is that correct?
Yeah, that is correct. And maybe before I move there, one thing I should go back and mention on the capital gains is the way that proposal works, that the increased capital gains tax rate would not be effective on January 1st. It would actually be effective for any capital gains realized after September 13th, which is the date the bill was introduced into committee. There's some exceptions for sales that were negotiated and kind of ironclad before that date, but the cash hadn't been paid yet. But in general, if you realized a long-term capital gain after September 13th, that higher rate could apply. And then, Peter, you're absolutely right. So there's a couple of changes in here that would disproportionately impact business owners versus folks whose most of their income is coming through a W-2. And so the one is that net investment income tax that I just talked about, is they would apply that to what they call non-passive business income, right? So, assuming you own any type of business, right? You're a wildly successful restaurateur, right? And your taxable income is above those $450,000 thresholds that we already talked about. Previously, depending on how your business was structured from a legal standpoint, that income from your business, not the wage that you pay yourself as a business owner, but the excess profit of the business, usually was not subject to this 3.8% net investment income tax if you were actively involved in the business. And what this bill would do is if you are actively involved in running the business, those excess profits above those thresholds would be subject to the 3.8% net investment income tax, just like interest and dividends and capital gains would be. The other thing that it does is the 2017 Tax Act introduced this, what's called the 199A deduction or the qualified business income deduction, which allowed folks who ran certain businesses to actually exclude a portion up to about a 20% deduction of their business income, right? They got to take that off the top and it wasn't taxable. I'm vastly oversimplifying it. But what they would do is they would actually put dollar caps on the size of that deduction. Again, depending on your income level, are you a single filer or a joint filer? I believe the caps are $400,000 single. Hold on just a second.
Thinking it's $500,000 for married filing jointly. Mm-hmm. I have them here. And then $10,000 for estates and trusts.
Right. That's the income levels at which the cap would start to kick in. And it gets phased in to where if you have more than $2.5 million of that non-passive business income, you essentially get no more benefit from the QBI deduction. So it's the way it ends up working is kind of like a hard dollar cap on the deduction you can take. Before it was a percentage, and it wasn't limited unless you were in a certain type of business, like our business as a financial advisor or a CPA or an attorney. Those were called service businesses, and they already had limits placed on them.
And so we're talking about a lot of things thus far in the proposals that are really impacting that group in the, say, $400,000 to $500,000 range, and certainly above. I think if you're above $400,000, there's a lot of places where your taxes can go up. And we've also honed in on business owners a little bit, some key differences. But one sort of popular strategy that seems like people of all income levels utilize these days is that backdoor Roth contribution. And for those listening who are not familiar with this strategy, just at the highest, simplest level, when you make a contribution to, say, a non-deductible IRA and you convert that into a Roth IRA, assuming there's no other IRAs there, assuming there's been no growth, you're able to not owe any income tax on that. Now, typically there's some growth there that's taxed, and typically you have IRA assets that make you subject to ordinary income. But just kind of at high level, this has been a way where people who have earned too much to qualify for a Roth IRA have been able to get assets in there. And then similarly, there's been some changes to those who perhaps would be converting any type of IRA balances to a Roth account, strategy we typically are doing as people near or just enter retirement. But just kind of with that background, there are some changes. Some of that's allowed now, some of it's not allowed for a while, some of it will eventually all go away. So what is that being proposed to look like?
Yeah, no, great question. And I think you also called it out a little earlier. It's a good point to repeat, is that, again, the way that this bill or this proposal is designed is most of the impact is on quote unquote high income taxpayers. And they're defining that as $400,000 plus for a single filer, $450,000 plus in most cases for a joint filer, right? And they've been talking about that right all the way back since the last presidential campaign, right? So they're focusing on changes for high income taxpayers. And so this proposal that you're now talking about is actually one thing that would impact people below those income amounts potentially, because it introduces something that says if you make an after-tax contribution to a traditional IRA or a traditional 401k, for example, you will no longer be able to convert those after-tax dollars to then a Roth account after December 31st of this year. So you could still technically make an after-tax contribution to that account, but you could no longer convert it to a Roth account. And so that kind of hits on, okay, one of the potential year-end planning things is if these backdoor Roth contributions have been part of your savings strategy, and maybe you're someone who has always waited until after the end of the tax year to determine, hey, can I make a Roth contribution directly, or do I need to make a backdoor Roth contribution based on my income? And under the old rules, you had all the way until April 15th of the following calendar year to make that decision for the prior calendar year. Well, if this went through as written, you wouldn't be able to do that for 2021. And so I think if you're someone who has utilized on Roth contributions or backdoor Roth contributions, it might be worth going ahead and making that after-tax contribution to your IRA before the end of this calendar year and doing the conversion before the end of this calendar year, because after that, no one would be able to do it regardless of income level. Then, Peter, you alluded to some of the other things, in that you can also convert pre-tax dollars from an IRA or a 401k to a Roth account. And that's a taxable event. You pay tax when you do that. You'll still be allowed to do that for the next 10 years, regardless of income level. So until the end of 2031, which kind of sounds weird to say. But it's also, I think, one of those ways that they're actually, again, they're working on the scoring of the bill. So by leaving that 10-year window, they're still allowing the people to do these pre-tax conversions, which they are then estimating will generate additional revenue. Now, after that point, once you get post 2031, then income limits do kick in to where you would not even be able to convert pre-tax dollars from IRAs or Roth if you're a single filer and your income is over $400,000, right? Or if you're a joint filer and your income is over $500,000, which is interesting because many years ago, actually, like before the financial crisis in 2008 and 2009, there was an income limit to do any Roth conversion in the first place. They actually lifted it during the financial crisis as a way to raise revenue. So,
first of all, I will put some links to information on Roth conversions into the show notes. And I think, Brian, we're obviously not going into every single detail of all the different proposed changes, but with those sort of headline things in mind, we talked a little bit about tax planning opportunities. You mentioned maybe you do that backdoor Roth contribution earlier as opposed to later. Are there any other things that people ought to be thinking about as it pertains to what we know as of now about a proposal, recognizing that things may change?
Yeah, I think as it relates specifically to the proposal and on the income tax side, a lot of it is going to be in general that planning of, can I accelerate income into this tax year where I can maybe pay a lower tax rate? And can I potentially defer a deduction into next tax year when I might get a higher benefit because I'm going to be in that top marginal bracket, and so my rate's going to be higher, right? So on that first example of, can I accelerate income? And we'll focus mostly just on individuals and not business owners, as we talk about this. But so again, it could be a Roth conversion, right? It could be an early distribution from a traditional IRA account if you're over 59 and a half, so that you're accelerating that taxable income into this tax year. That's, in general planning that we do, right? If somebody's in some of the lower tax brackets, right? And we know they're going to be in a higher tax bracket in the future, we try to fill up those low tax brackets, the 12%, the 22%, the 24% bracket. We try to fill up those low brackets with income so it's not taxed at a higher rate. What you have this year is you could even have somebody who is paying the top rate today at 37%, right? They're going to pay the 39.6% next year. And so you actually want to accelerate some income into this year and actually pay 37%. Or the other thing to think about is you actually might increase the brackets that you want to fill up, because part of the marriage penalty, or part of what happens in these new brackets is, for example, right now we have a 35% marginal bracket. We'll still have a 35% marginal bracket. It's going to be really, really small. It's going to be a really narrow bracket. And so, for example, you might, instead of stopping filling up those lower brackets at the 24% bracket, for somebody who's going to be in that top 39%, 39.6% bracket next year, you might actually want to fill up some of those other higher brackets that are wider this year. So you could tax more income, for example, at 35%, and that income would likely get taxed at 39.6% next year. I think even going above that for really high income folks, say like a high level corporate executive, they have a lot of stock options, for example, maybe non-qualified stock options. If you have a really large grant and next year your income would be over $5 million and you're comfortable exercising those options for the end of this year, not only could you save on the marginal rate, but you could avoid that 3% surtax that we talked about. So there's a number of other ways to accelerate income. Those are just a couple.
Yeah, and the people who are usually in the best positions to accelerate income or look at different timing of deductions are those business owners, or like you said, maybe an executive or someone with significant equity compensation. And I think we're just getting ready to enter into tax projection season at Plancorp. When I say we, I don't mean me, I mean you and the other CPAs. And so I think maybe this goes without saying, but if you're a business owner, I think this is, and you don't normally do tax projections, this is certainly a year to be getting on that sooner rather than later. I guess the other question I have for you, Brian, is you mentioned the higher capital gains rate that's being proposed. When we think of people who aren't business owners and are looking for ways to, say, fill up a lower tax bracket, that seems to be another place where potentially there could be some benefit. Is that right?
Yeah, no, I think that's true. I mean, if your income next year, again, would kick you into that higher long-term capital gains rate of 25%, and you could realize that capital gain this year and not be subject to that higher rate that would apply after September 13th. So it's a little more nuanced, right? Because technically, as what we know right now is that if I sold stock today and I'm a high income taxpayer, right, that higher rate's going to apply to me today on September the 24th. So you kind of also have to have a sense of, okay, how much gain can I realize in 2021 before I get to that 25% level? And if you still have kind of some of that room to fill up, to your point, and you know otherwise you'd have to realize that gain next year and pay that 25%, maybe you can pay some of it this year at 15% or 20%. Could absolutely be a way to save on the tax rates as well.
Well, and I'm going to cautiously dip my toe into the estate planning part of this, because there was some concern that we would see a proposal and where there would be the removal of that step up in basis at death, in which case, if you're holding assets, we were already having conversations of, might we sell assets in 2021 at a lower capital gains rate, get the basis to step up. But, just as big of a news as what is in the bill is what was not in the bill. And so on the estate planning side, we didn't see that step up in basis going away. We saw that remain the same. We saw that there weren't any changes to the tax rates on the estate and gift taxes, although I guess they were cut in half. So the estate exemption is half of what it used to be. What are some of these other headline estate planning changes, and what was left out that you think is impactful as well?
Yeah, I mean, the stuff that is left out, I think, is important to discuss, because as we get into this negotiation between the House and the Senate, it's possible that some of that stuff could come back in, right? And so when we say it was left out, what we mean is these are things that were in the president's proposal that did not end up making it into this House legislation, right? Or what people are calling the House proposal. And so it is things in the president's proposal. He had proposed not only eliminating step up in basis. So right now, if I own shares of Apple stock, right, and I got really lucky and I bought them for $50 a share, if I pass away, my basis becomes whatever the fair market value of that stock was on the day that I died. So my heirs could sell it and there's no built-in gain or loss, right? And so they had proposed eliminating that. And part of the argument is that the president also wanted to increase the capital gains rate. And people say, well, if you do that, but you also don't eliminate step up in basis, people will just hold on to the assets. They'll never sell them. And so we had a lower capital gains tax rate increase, and then there was no elimination of step up in basis. And what Biden really did is not only was there going to not be a step up, it was going to be a deemed sale of all your assets when you died. You didn't actually have to sell them, but they were going to calculate what the built-in capital gains tax was, and your estate was going to have to pay that tax. when you died. There were certain exceptions for family businesses and farms and things like that. None of that stuff ended up in the House proposal, but doesn't mean that as they negotiate with the Senate that some of that stuff might come back in. So it is important to kind of keep some of those things that weren't put in there in the back of our heads, especially because yesterday they've agreed to, they had this list of potential funding options they're going to consider. No one knows what the list is, but I have to imagine that some of the things that the House left out of their proposal are on that list as possible options, step up in basis being one of them.
Well, I think that, you're talking about some of the things that got left on the table. And when we talk about the implications, some of the other headline changes that were proposed, these are really for people who now, as a married couple, have a joint estate of over $10 million, right? I'm missing the number just barely. I know, it's $5 million and change per individual. But when we think about the estate planning techniques and the types of things that we're looking for within the proposal, a lot of times our job as advisors is not just to make sure that assets are passed and are controlled in a manner that you want past your death or an incapacitation, but it's also finding ways to get assets out of your estate or get asset growth out of your estate. And there did seem to be some uncertainty leading into the proposals, recognizing that we're going to get into the nitty gritty here just a touch. We try to keep it as high level as we can. What is some of that looking like for you? And what are some conversations and things that people ought to be thinking about in that situation?
Yeah, so let's start. Let's talk about the lifetime exemption from estate tax or gift tax that everyone has today. It's $23 million, right, for a married couple. It's the amount of assets you can pass free from estate tax. The rate above that amount is 40%. So that amount was doubled back in 2017 and was already scheduled to be cut in half on December 31st, 2025. That was part of what many people call the Trump tax bill, right? They increased the exemption, they doubled it, but then they were going to cut it in half at the end of 2025. And every year it increases a little bit by inflation. And so we've really been, kind of beating the drum with clients who have certainly a net worth above $23 million that if they haven't already used that exemption to pass assets out of their estate while they're alive, right, whether through trust or other gifts to individuals, and they can, this is important, they can afford to make that gift. They're not going to impact their own lifestyle by giving away those assets. We had really been encouraging people to use those increased lifetime exemptions as soon as that was introduced, right, on January 1st, 2018. We're hitting it hard last year in preparation for the election. I've been talking about it all this year. Because even if it wasn't going to be reduced by legislation, it was going to be reduced in a couple years anyway. The House proposal basically cuts it in half. What they say is they take away the extra exemption that was given in the Tax Cuts and Jobs Act, right? They're not cutting it, they're just taking away the extra. And so what we think that means is with the inflation adjustment is that each person will roughly have about $6 million of estate and gift exemption in 2022. And so to your point, then you're not talking necessarily about folks with a net worth in excess of 23 million. You're talking about in excess of 12 million. And so again, if they have enough assets to take care of their own financial independence, and again, this is where, good planning comes in. You got to address that first. Then they ought to really think about giving away some of the exemption that they have today. And the way that works, the math's a little funky, right? If you just give away $1 million, you haven't done anything because that $1 million is going to come out of the $6 million that you have available next year, right? So even though I have, say, $11.5 million today, and I give away $1 million, next year I'm going to have $5 million of exemption left because I've used $1 million. And so really, if you're going to do anything, here at the office, we say, go big or go home, right? So if you're not going to think about doing anything above $6 million in terms of using this lifetime gift exemption, from a pure tax planning standpoint, right, you're not necessarily going to achieve very much on day one, right? Now, those assets are still going to be outside your estate. They'll hopefully grow outside your estate and avoid estate tax. But in terms of using the extra exemption that we have today, unless you use more than what we think the exemption will be next year, you haven't achieved much. And when you think about a married couple, what you would actually prefer to do is that one person in the couple exceeds $6 million or uses all of the roughly $11.5 million exemption that they have today, that one spouse would use it all up before you would start on the exemption of the other spouse. That would be better planning than both spouses doing some. And so that's on the exemption front. So use, if you're lucky enough to be in that bucket of people, do your planning. Can I afford to give away some assets? And then think about then how do you want to structure that, which is then where some of the other headlines come into play.
And if you're listening to some of these numbers and saying, gosh, these are big numbers, do remember Brian is the head of our family office. And so, these are real conversations we have to have. But even those who still have substantial wealth, but maybe don't have the type where you're giving away that amount of money at this point, we've traditionally used a lot of strategies like GRATs, for example, where we're not totally sure where those are going to line up. And I think, Brian, you have a great article on our blog that I'll definitely link to in the show notes on GRATs and just the basics of how they work. But I'm going to high level tell people that basically you're just putting assets in a vehicle. And if the growth rate exceeds what's a pretty low interest rate, let's just call it 2%, for example, and you put in a stock fund that grows 8%, well, all growth above that 2% is going to be removed from your estate. And so that's a strategy that we've used a lot for many, many years. I do know that there was some language in the proposal that might impact that. Maybe you could touch on that briefly before we talk about just some of the broad year-end tax planning stuff that would apply to anybody.
Yeah, so really what's in the proposal is broader legislation that would impact all of what are called grantor trusts. So what a grantor trust is the most common type of trust that most people have is just their revocable trust, right? It's the relatively simple trust that you create to avoid probate and make sure all your assets go where you want them to go when you pass away. If you have one of those, you probably know that trust does not file its own tax return. In fact, it probably uses your own Social Security number as its tax ID. And that's an example of a grantor trust. The person who created the trust retains enough control over the trust that the income of that trust is still taxed to the person who created the trust. It's reported on your personal tax return. You don't necessarily have to file, the trust doesn't have to file a separate trust income tax return. So a revocable trust is a very simple example of that, but there's then more complex examples like a GRAT, that you mentioned, others that are called, for example, spousal access trusts, right? One of the benefits of these types of trusts is essentially the assets inside the trust can grow income tax free. And especially if the person who set it up has a taxable estate, they get to pay all the income tax dollars out of the assets that remain in their estate. And so even if I'm in the highest bracket, which is 37%, if you think about it, I'm only actually paying 60% of that rate because I'm paying that tax with dollars that will otherwise be subject to estate tax. So some folks call this the tax burn, right? The estate tax burn, because you're burning up other parts of your estate by paying income tax dollars on assets that you've moved out of your estate. So it's a very powerful technique. They've been trying to put limits on this for quite some time, always going back, to President Obama's administration. It was in all his budget proposals to put some limits on these types of strategies. And so this is another one. Most of the things that we've talked about so far on income and estate tax, they would go into effect on January 1st of next year, right? So next tax year. This change to the grantor trust rules would actually would go in effect on the date of enactment, meaning that once it's passed the House, it's passed the Senate, and the president signs the bill, that's the date these grantor trust changes would be in effect. And if you had created a trust before that date, it would in effect be grandfathered unless you put more assets into it after the date of enactment. And basically what it says is if you create a grantor trust after the date of enactment, those assets are not outside your estate. They're includable in the grantor's estate. And so, again, if you create a GRAT after the date of enactment, it's not going to be, I shouldn't say it has no benefit, it has drastically reduced benefit, as will many other common types of grantor trusts. And there's other wrinkles to GRATs, which if Peter's going to link the article, we talk about in that article, so I won't get into the weeds, but even just how GRATs function and some of the neat things you can do with a GRAT, for example, let's say we create one today and they pass the bill in a month. After that month period of time, some of the things that we would do today to kind of manage a GRAT during its life or during its term, you might not even be able to do some of those things any longer. That's not explicitly stated in the bill, but people are assuming that's how that'll work.
Well, and I know there's some trust tax planning that you could probably do this year and beyond. But I think in the interest of time, because again, I want to hit some of the year-end tax planning things that apply to all people of income and wealth levels. Maybe we'll save that. I'm hoping I can talk you into coming back on once a bill is finalized and we can give hard analysis of what it is that we're dealing with. And with all these things that we're discussing, you just mentioned even something like setting up a GRAT this month, or any of the tax strategies we've talked about, even just running a simple tax projection. These things take time. And so if you wait until December, when we as advisors are working and we're effectively prescribing, making recommendations, you can't prescribe without diagnosing. And so I think if you're not working with someone who has the tax and estate planning background, you kind of have to get on that now. I mean, when we think about even just what goes into the first step, we build these financial plans, and that takes some time. It takes some effort. So these are big changes. Tax laws change all the time. Not every year, but it's not like we won't have changes again in the future. However, that's typically when the opportunities for big savings and big planning opportunities are, right around the time when this stuff happens. So I'd encourage people, if you have questions, to get on it, to reach out to us. I think, Brian, if we think of those even year-end tax planning items, those two are things that you can't just wait until the last couple of weeks of the year. Running down a handful of the things that we talk about, maybe we could start with charitable giving, because I think at year-end, people are in the giving spirit. Charities tend to reach out with more asks. Maybe you know where your income is, and if you've done this tax projection like you should, you know where you could benefit. High level, just what are some of the things that we're still doing regardless of these proposals with charitable giving?
Yeah, so I think a big thing with year-end charitable giving planning is, and this changed a little bit after the Tax Cuts and Jobs Act back in 2017, is, so one, I think you always want to be smart about what asset you're going to give to charity, right? So if I want to give $1,000 to charity, right, I can just write them a check, or I can give them an appreciated asset like shares of stock. And then whatever gain I have in those shares, if I give those shares to the charity and they sell the shares, they don't pay tax on that gain, whereas I would. So in effect, not only do I get a deduction if I give appreciated securities, I also get to eliminate that gain, right? Kind of from like my tax ledger, right? I don't have to pay that tax anymore. I gave that tax to the charity. So I think always being smart about the type of assets, how you're making gifts to charity. And then the Trump tax bill introduced this concept of what a lot of people call bunching your charitable contributions. And so that means, we now have much higher standard deductions than we used to have. For a married couple, it's over $25,000, close to $26,000. Single filers, it's half that, right? And so if you think about that, if I'm someone that, I don't have a lot of other things that would qualify as itemized deductions, like mortgage interest, or for example, there's the state and local tax cap of $10,000, which is a big deal in these House and Senate negotiations, which we didn't even talk about. But if I don't have enough of those other deductions and I give $1,000 to charity, and then I claim the standard deduction because it exceeds my itemized deductions, well, I didn't technically get any extra tax benefit from making that charitable contribution. It's not the only reason to give money to charity is tax benefits. But if you want to maximize it, right, and you have the ability to do it, what you can think about doing is, gosh, how much money do I think I'm going to give to charity over the next 3, 5+ years? Let's say that number is $50,000. And what I'm going to do is I'm going to set up a donor advised fund, which is itself a charity. And I'm going to take $50,000 of appreciated securities. I'm going to put it all into my donor advised fund this year. And I'm going to get a $50,000 tax deduction this year. And now that pushes me up above the standard deduction amount to where now I can itemize and now I can get some benefit from that deduction. And the nice thing about a donor advised fund is you can then parse those dollars out to actual end charities over basically an unlimited period of time. And you can give really small amounts out of a donor advised fund, I think as small as $25 in most cases. So that's bunching on the charity side.
Yeah, and we have an article about that I can link to in the show notes. And you had mentioned something like giving $1,000, if you have the standard deduction, doesn't do much. I believe you're the one who told me in 2021, you can, for a one-time, get a $600 deduction. Is that right, if you're taking the standard deduction? But the other thing that I've noticed more often in client meetings when we're looking at different options are retirees with IRAs who are forced to take distributions, those required minimum distributions or RMDs, can sometimes get a bigger tax benefit out of making the gifts directly from their IRAs. Can you talk a little bit about that?
Yeah, that's absolutely correct. And that's called a qualified charitable distribution. They've been around for quite some time now. And what it basically says is once you're 70 and a half, you have the ability to take $100,000 a year out of your IRA and give that money to public charities. You cannot give it to a donor advised fund, which is a question we get a lot. So it's got to go directly to a charity that you want to donate to. So the nice thing about that is that those dollars also directly offset your required distribution. So that required minimum distribution that you mentioned, which now doesn't start until age 72. But if I have a $50,000 required distribution from my IRA, I can take $50,000 and give it to charity. I can take $20,000. I can go all the way up to $100,000. And the nice thing is that the money that I'm taking out of my IRA to give to charity, I'm not taxed on those dollars, right? It doesn't hit my tax return as gross income. I don't get a charitable deduction, but the reality is I'd rather the income not hit my return. And the reason being is that so many things in our tax formulas are based off of your gross income. And so if I otherwise would have had to take $50,000 as a required distribution, and now I can avoid it, well, now I'm reducing my gross income, which impacts phase outs and all sorts of other things. So typically, if you look at writing a $50,000 check, giving $50,000 of appreciated securities, or doing a $50,000 qualified charitable distribution, if I'm a retiree and eligible to do a QCD, that's typically going to result in the biggest net tax benefit. And there are some proposals out there to actually increase that $100,000 limit. Many thought that might pass this year, but with everything else they're dealing with, I don't know if they'll get to it. But it's been $100,000 since it was originally introduced and never increased for inflation. And one of the other cool things you can do is for those people that I'm 70 and a half, but I'm not 72 yet, right? So I can give QCDs before I ever have to take an RMD. And then that reduces my required distribution once I'm 72 because I have less assets in my IRA now.
That's a great point. And one of those things where sometimes, again, I'm saying tax projection like a broken record here, where the sooner you can get on this and find out if that's more beneficial or even just a cost benefit analysis rather than a full-blown tax projection can be helpful in determining those. Same with something like we've already talked about tax gain harvesting. We frequently talk about tax loss harvesting. We look for those at the end of the year, trying to find assets that have depreciated that we can sell and buy a like security while capturing that loss to offset gains in the current year, as well as a little tiny bit of ordinary income or in future years. Just kind of walking through some other things that give you quick deductions, HSA contributions, retirement plan contributions, whether that's a traditional 401k or deductible IRA, simple or SEP IRAs. And then at the state level, if you have state taxes, we often are talking about 529 contributions. Brian, those things that I kind of rapid fired off here at the end, any kind of comments on any of those to kind of wrap us up here?
No, I think, obviously just being aware of the different contribution limits for those plans. And, even I would add to the HSAs, the health savings account. For example, there's a special rule this year for flexible spending accounts where some of the legislation earlier in response to the coronavirus increased the annual limits that you can put into an FSA for dependent care, for example. Now, your employer has to have put that into their plan and allow for it. But that could be another thing where you could take advantage of a temporarily increased contribution limit, which might not be permanent, and stuff more dollars into a pre-tax bucket that you can then spend on things that your family needs. So that would be just maybe another thing to mention along with those other things that we kind of always have at the end of the year, HSAs and IRAs. And so just be cognizant of the contribution limits. A lot of the contribution limits are impacted by what your income is. So again, just be thoughtful, have a plan, make sure you actually qualify for what you're doing. Even with, for example, state level 529s, make sure you actually get a deduction in your state for that contribution because some states don't offer that, right? For example, California doesn't have a deduction for 529 contributions. Here in Missouri, we have one. So, just being cognizant of what the rules are and that the rules apply to you and your particular situation.
Well, Brian, thank you so much. Again, I'm hoping I can get you to come back and do this again with me when we have more information. And obviously, anyone who's listening, everyone at Plancorp knows what a treasure wealth of information you are. So I think everyone got a little tiny taste of that today. If you want to have show notes, you can go to thelongterminvestor.com. If you have comments about the show, please leave us a review. We read every one of them. It helps others find the show. Brian, thanks again. And to all of you listening to Long-Term Investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of Plancorp and Brightplan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of Plancorp or Brightplan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Plancorp and Brightplan may maintain positions in the securities discussed in this podcast.